Let's talk about the key business impacting reforms from Union Budget 2026 across regulation, direct taxes, and indirect taxes. This is a quick and clear roundup of what really matters for companies and investors. Union Budget 2026 signals three clear regulatory priorities. First is strategic manufacturing security. The focus remains on semiconductors and electronics, rare earth magnets, chemicals, biopharma, and container manufacturing. These sectors sit at the heart of electric vehicles, defense, and clean energy supply chains. A single electric vehicle today relies on rare earth inputs sourced across multiple countries. India is now making a serious attempt to localize this entire value chain. Second is cheaper logistics to improve export competitiveness. Freight corridors and national waterways are meant to shift cargo from roads to rail and water. Inland waterways can reduce bulk transport costs significantly. For exporters and heavy manufacturing businesses, this directly improves margins and delivery timelines. Third is easier foreign investment and deeper capital markets. FEMA rules governing foreign investment will be modernized and the corporate bond market will be strengthened. For multinational companies, this means better funding options and more flexibility in structuring India operations. Big shift in direct taxes. A new tax era from 2026. From 1st of April 2026, the Income Tax Act of 1961 will be replaced by the new Income Tax Act of 2025. This brings an end to a framework that has been in place for 65 years. Financial year 2025 to 2026 is the final year under the old law. Tax rates remain unchanged. The focus this year is on stability, simple rules, and fewer disputes. There is a structural change to minimum alternate tax, MAT. MAT has been reduced from 15% to 14% and will be treated as final tax under the old regime. MAT credit will be restricted for companies shifting to the concessional regime. The change nudges companies to move out of the old regime and will alter cash flow planning for capital-intensive businesses. Buyback taxation has returned. Share buybacks will now be taxed as capital gains instead of dividends. This changes how promoter exits are planned, how group restructurings are done, and how multinational groups repatriate cash from India. A one-time compliance window has been introduced for small, unreported foreign assets. Individuals can regularize past non-disclosures by paying additional tax and without facing prosecution. This is a trust-based cleanup of legacy issues. There are targeted incentives aligned with global trends. Foreign companies using Indian data centers will get tax exemption until 2047. Foreign suppliers of capital goods to Indian contract manufacturers operating in bonded warehouses get tax relief until 2030 to 31. Non-resident individuals returning to India can claim exemption on overseas income for 5 years. Together, these measures support cloud infrastructure, electronics manufacturing, and global talent mobility into India. Transfer pricing reforms are meaningful, especially for the IT sector. Safe harbor margins are now consolidated into one IT services category at about 15.5% over cost with a much higher turnover threshold up to 2,000 crores. This is expected to support expansion of GCC infrastructure in India. Fast-track unilateral APAs have been introduced. Late filing of transfer pricing reports will now attract graded fees instead of a flat penalty. On GST, long-pending issues are finally being addressed. Post-sale discounts and credit notes are now easier to structure. However, output tax can be reduced only when the buyer reverses input tax credit. This places greater reliance on system-driven compliance through tools like the invoice management system. Provisional refunds are now available for inverted duty structure cases. This will ease working capital pressure for manufacturers and traders stuck with accumulated input credits. Conflicting advanced rulings will now be streamlined, with the GST Appellate Tribunal stepping into the national level until a permanent appellate authority is constituted. There is a major shift in intermediary services front. The place of supply will now be based on the recipient's location. Intermediary litigation under GST has been pending since 2017, with disputes involving tax demands of over 3,300 crore rupees. The change brings long-awaited clarity going forward, although past disputes will still take time to resolve. On customs, the focus is clearly on trade facilitation. The validity of advanced rulings has been extended from 3 years to 5 years, giving importers longer certainty on classification and valuation. The tariff structure is being simplified through tariffication and pruning of exemptions, which should reduce disputes at ports. Targeted tariff updates support domestic manufacturing and will require companies to revisit landed cost models. Duty deferral timelines have been extended from 15 days to 30 days. What businesses should do next? This budget is not about short-term tax relief. It is about reshaping how companies invest in India, how profits are repatriated, and how supply chains are built. Immediate action points for businesses. Review buyback and match strategies. Be New Income Tax Act implementation ready. Reassess GST positions for intermediary services and discount structure. Conduct an ERP and SAP review to incorporate new tariff rates and custom process changes. Review customer and distributor contracts to operationalize post-sale discount structures. Re-evaluate GST refund eligibility for intermediary supplies that may now qualify as exports. That was your Union Budget 2026. Hope you found it helpful. Stay tuned for more such updates.